Good morning, Doc.
Yeah, good day, Graeme. Here we are heading towards, can you believe it, the Easter holidays, Graeme. I hope you've stocked up on your Easter eggs and you haven't been eating them before the go button, but it's...
No, I'm on 75 hard, Doc, and I'm on 75 hard. I'm on my water and my 2 exercises a day,
Brilliant.
but I actually turn 40 when the Easter Bunny comes this year.
Oh,
So
mate. Well,
I'm over the hill in a couple of weeks, Doc.
Well, you're allowed to binge a little bit over Easter, Graeme. I mean, those Easter eggs are hard to resist, aren't they? So we're only 3 weeks away from that. Yeah, so
I finished
good luck
then,
with
so
all
I'll
that.
enjoy some Easter eggs for sure.
Well, we've had a big week in property again this week. I think we say that every week because every week's a big week, but we've had some, I guess in terms of the big picture, the economy, we're getting this left field issues rising in terms of the banking sector. Will that have an impact on the future direction of interest rates? We're seeing banks that are under pressure being bailed out by governments and the finance sector. Will central banks now start thinking, well, we can't afford to maybe put up interest rates as much as we were going to because it's obviously putting some stress on some banks? Or do we stick to the main game and control inflation, which, to be quite honest, isn't really looking or certainly hasn't reached the levels which central banks would have hoped they would have reached, in other words, fallen, despite nearly a year of higher interest rates, Graeme. And, we've got the US meeting today or later tonight to decide its interest rate policy. It hasn't met for a couple of months. And earlier in the month, there was a lot of talk that they'd go up 0.5%, which would be higher than the 0.25 they've been putting it up recently because they're concerned with inflation, but because their economy also is absolutely booming. Their jobs market is flying and surprising all the so-called experts again. And, but now, of course, since that very strong economic data, we've had these issues in the US with the banking sector, which is different to ours. We must reiterate the US banking sector is a lot more fractured in terms of having various different levels of banks, small banks, medium banks, big banks, and they all have different exposure to risk because obviously the smaller enterprises are a bit more risk averse, but they don't have or risk inclined, I should say. They don't have the support that the big banks have in the US from the financial sector. We're already seeing a couple of banks having to be bailed out. The question is, whether this is an ongoing issue and the costs that are involved and whether putting up interest rates will make things worse for these banks that are under pressure. And, of course, confidence is everything, Graeme. They've got to keep depositors confident in the banking sector or they'll start thinking, I'm going to get my money out of your bank, mate. And, we don't want to run on banks happening because, that's very dangerous. But, I think that we're clearly
the crypto bros would love that. But, I don't think we actually want that in the economy. That's for sure.
Well, a lot of this is driven by, to some degree, the woke agenda, Graeme. A lot of these smaller banks have followed up with their investment decisions on particularly the big Biden policy, which is giving very strong support to renewables, to the climate change industry. That government support has obviously been a catalyst. Strong government support has been a catalyst for businesses to move into that sector and invest in that sector. And, there's still a lot of water to go under the bridge, as we know, with the carbon decline, I guess we could call it, focus on energy. It's a risky business. And this has been part of what's caused, particularly the Silicon Valley Bank to close. Certainly to close its doors for now, has been its exposure to a lot of those investments in those, type of renewables focus. So, and there are other banks who are in line with that. So most of Silicon Valley had their money in the Silicon Valley Bank. I guess that makes sense. But a lot of that is for startup speculative activity, and this has been softened softening, really, not just recently, but over the last 6 months or so. So will the Fed, blink and decide, nah, we'll only put it up 0.25%, or we won't put it up at all? So interesting,
We'll
an
see.
interesting decision to come.
Time will tell. Now, Doc, we've been talking about regionals a bit. We get a lot of question about regionals and the COVID effect and all that sort of stuff. And will it really boom, or will it just tick along? Now, have you've come to that data yet? Have you put together a bit of data on regionals to share as well today?
Yes, Graeme. Well, we'll look again to start with at the economy, and we have had some very important economic data out in Australia over the past week, focusing particularly on the labour market. Some remarkable data from the labour market. We'll have a look at that. It obviously has big implications for interest rates. But following that, let's have a look at. We'll have a look at the major regions, Eastern Seaboard regions, how they've performed this year so far and over the past year and 2 years. The only place you'll find this data, Graeme, is here with all that latest regional data. So we'll have a look at that after we discuss the latest economic data. So shall we get started, Graeme?
Absolutely. Let's rip in.
Well, of course, the latest data I mentioned was the unemployment data, or the labour market data for February, that was released by the ABS last week. And it clearly calls into question how effective interest rate policy has been in quelling economic activity. We've had interest rate increases now for 10 consecutive months, likely to get another one, but, we'll talk about that in a sec. There's been a lot of speculation reflecting what was said in the Reserve Bank minutes of its March meeting, that they might even put rates on hold for their next meeting, which of course is the April meeting coming up in a couple of weeks. I think that the media, as usual, has just grabbed onto a headline or a snapshot, or for a headline has grabbed onto a comment from the Reserve Bank in their minutes where they said that they're going to reconsider the timing of when they will pause rates, but they didn't say they were going to. They just said they'll think about that going forward. But they also said they'd think about everything else as well. I mean, if you talk about having two bob each way, the Reserve Bank of Masters are doing that, because basically their whole commentary was, well, it might go higher, then again it might go lower, it might go west, it might go east.
It could go round and round in circles, and if we're wrong, we'll just apologise and get on with it too, Doc.
Yeah, but if we say it might do this and it might do that, it's like betting, putting your money on every horse in the race. You know what I mean?
It's almost like an odds for winning and losing. You can't lose. Right.
Yeah, so interest rates might go up, but interest rates might go down. So they're either way, they're right. And the Reserve Bank's commentary really has been very much focused on this uncertainty and, the fact that there are risks in either way. So I guess they're covering their bases, but at the end of the day, they really don't know. They don't know, with any certainty, the short-term direction and even the medium-term direction. And a lot of their forecasts, of course, have been well off the mark, and they've, underestimated how strong the economy would be. They've overestimated, the weakening of inflation. So, but that's the point. But they did mention in their commentary, the minutes which were released yesterday, Graeme, that they will discuss again, when they will go next month, when they will think about having a pause. They didn't say they were going to have it. They just said, well, we're going to talk about it. And since then, we've had these very strong numbers come out in the labour market, and it just shows us that monetary policy is not working as it was hoped it would work. And it's the same, as what occurred before COVID, when lower interest rates weren't producing growth as they were supposed to post the GFC. Now we've got the complete reverse, where higher interest rates aren't dampening growth. So, it doesn't sort of fill you with a lot of confidence as to the certainty of our economic policy makers. And, let's think about this as a statement, Graeme. Would anything be any different today if they hadn't have moved interest rates at all over the last 12 months or so? Would anything be different? What impact has it had? the only reduction in inflation is really coming from the easing of those supply constraints that we had through as a result of all that demand in COVID. Supply is now catching up with demand.
You've just given me a migraine, Doc. I like that statement. If interest rates didn't go up at all, would anything be any different?
Well, I don't think
not.
they would. And I think the housing market's shrugged off higher interest rates. We're seeing that. The Reserve Bank's always all over that negative housing market story. It's, they salivate at bad news housing market stories. And they've consistently got the housing market equation wrong, over a number of years. But and really, I'm not sure why they focus so much on it. Bit of a hobby horse of the governor. I think I know that. But at the end of the day, I don't even think that interest rates have had, except perhaps for a short-term blip last year through winter in confidence, where our housing markets are performing more in regard to, the typical cycle, not in regard to, affordability in terms of higher interest rates. Yeah. So interest rates, is it failing again? Well, what my fear is, Graeme, is that they're just going to have to bite the bullet and go harder. There's no point, I believe, in those 0.25% increases if they're committed to controlling inflation, which is what they're telling us all the time. Oh, we're going to control inflation. Don't you worry about that. That's our main game, blah, blah, blah. They're going to have to keep pushing them up and up and up, mate, because they haven't done a thing now.
Just go half or 0.6 if you really want to scare people. Just bang it on the head. Stop stuffing it about.
Yeah, because this is just doing nothing. And as you said, we've got all this demand coming in now from offshore. And that's not going to change.
That's an interesting one, Doug. I've never heard on my daily. I'm training for a half marathon at the moment. Would you believe it? But and I see, you're always running around town as well.
No, not as much.
Not as much these days. Okay,
no.
But mate, I'm hearing in Queensland here every day along the beach I go for a run. The amount of tourists, I think I've heard every language in the book, Doc, and they're out and they're spending money and they're not here broke. They're spending money and the Airbnbs are full and the hotel, and that's taking product out of the market in an already market that's lacking supply for rental and homes.
Yeah, that's right, Graeme. And
let alone the migrants that are coming in with work.
That's right. So, it's we have all these varied opposite forces working at the moment, and we're really some way off from sort of getting a balance. And there's some big questions about interest rate policy. It certainly failed to achieve what it was supposed to achieve over the last 12 months, and it's just a similar but opposite environment to what we had prior to COVID. But the real picture, Graeme, is that, and we can justify that by looking at the latest unemployment data, Graeme, back down to 3.5%. There was just a sense when we got the January data, and of course this is the February data. The January data actually showed the unemployment rate rising to 3.7%. It was the first sign maybe interest rates were starting to have an effect. We had the number of people in work falling. We had the number of unemployed rising. We had the participation rate falling, and there was some consistency about this. But that was January. Come February, all bets are off, Graeme. We had a really, really big month, down again to the record low, 3.5%. These are remarkable numbers, Graeme, really. And I think what we saw and what we're seeing now with our data is the impact of the seasonal modelling from the ABS, because it's all been, I guess, screwed up by COVID. All the seasonal models don't work as effectively because the seasonality went out the door because we had all that COVID lockdowns that impacted, activity at various periods that weren't necessarily due to seasonality. So we need some time to readjust those models. And I think that's what we're seeing, not just with the unemployment rate, which was lower in January, but now we also saw some issues with retail sales. So the unemployment rate back down again to record levels, Graeme. And it wasn't just unemployment. And if we look at the states' performances, we can see they're all lower than where they were a year ago. And the New South Wales unemployment rate, 3.1%, Graham, very low unemployment rate in New South Wales. Is there any, surprise given the strengthening Sydney housing market that New South Wales and of course Sydney have record low unemployment rates, and they're the lowest in the country of the major capitals. So, everybody's doing well here. Unemployment rates are lower, and certainly at those levels, which show a clear shortage of workers in the workforce. And we still, we've got record job vacancies and record low unemployment. This isn't the time to be, saying interest rates are working and we're going to put a pause on. How could they possibly justify that? But it's the weasel words that come out of the media, particularly the financial media, that are just looking for a bit of a cheap headline, and they pounced on that comment from the RBA that, next month they're going to look at the pause again, even though they were saying, well, we're going to look at everything again next month, and we're certainly going to keep increasing interest rates. So it was just part of that. They're saying everything at the moment so that all the bases are covered. But the jobless fell to 3.4%, Graham. It's another record low. We created 64,000 jobs over the month, mate. Big rise in the number of employed. The number of people without a job actually fell by 16,500. So good numbers. And the participation rate increased. So that means we actually had more people coming into the workforce, which could be part of that migration scenario that you were discussing. More people are coming in, the workforce is growing, and yet we've pushed the unemployment rate down and we've created another 64,000 jobs, and the number of unemployed has fallen. Mate, it doesn't get any better than this. This is an extraordinarily strong labour market report for February. Maybe there's a bit of the seasonality issues here. I don't know, bouncing back from January. Maybe we can blame the data.
Doc,
and as we saw,
we've got a booming labour market, booming economy. Let's look at the two-edged sword.
Yeah.
Do we have to, just as far as textbooks and policymakers go, for people that are playing along at home, do we have to break this and crack this booming economy and labour market, or is it okay to let it run for a while and grow?
Yeah, well, this is the conundrum, Graham. It is a two-edged sword, strong growth versus higher interest rates. And, higher interest rates aren't working. If this is what they're supposed to do, the Reserve Bank, is control inflation without regard, well, they have some regard to, obviously, the economic environment generally, but, it's throwing out the baby with the bathwater, is it not? If you start to think about, and I think to get inflation under control, we're going to need to have unemployment they're saying, okay, we're going to get back to 4.5% in a year or two, right? But I don't think that's low enough. I think we've got to have, we had unemployment rates above 5% prior to COVID, Graham. I think we've got to, obviously, and unfortunately, if the Reserve Bank's policies, positions are effective, we're going to have to get unemployment up higher than that to stop people spending. 4.5% is just too low still. It's still a strong economy. People will continue to spend. So that means they're going to have to keep putting up interest rates. They're going to have to do that. But, the joker in the pack is the banking sector. Not that Australia has that exposure, but it does have exposure if overseas banks start to feel the pinch and, interest rates don't go up overseas because they're trying to protect the banks. And that'll have an impact on the share market. It'll have an impact on confidence, and that'll eventually have an impact on us. But so far, we've had those 10 months of rate increases, and we still have an economy that is stronger than where it was when we started, Graham. After 10 months of rises, including a couple of 0.5% increases, we're still seeing a very strong economy. And the Reserve Bank's now talking about peaking out at over 4%. They keep pushing out their forecasts, and that's okay, but they've been doing it now for 6 months or more. So there's a lot of question marks certainly around the scenario. Now, next week, Graham, we will get the retail sales data out for February. And that'll be really interesting to see as well. I think it's quite, a lot of people sort of, if you talk about the Vox Pop, people, that are chatting at the moment, they're all saying, oh, things are tough and, we're in a recession. And you go, what? What are you talking about? You've just had a 5% increase in your wages, You got the phone doesn't stop ringing from people wanting to come and work for you. House prices are starting to rise again in the big markets. Everybody's up and about, still spending. They're going on trips overseas, Graeme. It's all happening. And yet we have this sense of pessimism, which I think is driven by a lot of those consumer sentiment surveys, which do not reflect what is actually happening in the economy because they're down and business surveys are down. And yet everything's going along hunky-dory, I mean, it's just, I don't think you should really take a lot of notice of those business and consumer sentiment surveys because they're not reflecting the real data, that is for sure. Just have a look at those unemployment numbers, Graeme. They're amazing. And as I said, we'll look at the retail sales data next week. That'll come out for February. And there was talk that, yes, January was a strong number, but the trend is a little bit lower than what it was towards the end of last year. So maybe that's a first sign. We'll see whether spending has eased. But as the Reserve Bank said in its minutes, Graeme, it could be this, it could be that, it could be this, it could be that. So they're not pinning their flag to anything on the mast at the moment. They're certainly well and truly in the land of the unknown in terms of what's happening in the economy and the prospects of what will happen and what they're going to do with interest rates. We mentioned migration, Graeme, and fortunately we have some migration information. The latest migration information shows us, as you suggested, that migration is just booming at the moment. This is backward-looking data, but it is the latest official data from the ABS, Graeme. It is for the September quarter, which is the latest data, but it does reinforce what we know is occurring in the economy. Can you see that reverse? This is annual net migration, how that has bounced back since borders were opened up. Look at that. It's just, wow, it's a surge. And this is September, Graeme. This is the year to September. You can see Queensland is still the top state in terms of net migration. Of course, that's the difference between people coming in and leaving. But look how New South Wales is now surging. It's growing faster than Victoria, which typically is the land for overseas or the destination for overseas migrants. But we've had a remarkable surge in net migration into New South Wales. Also, Victoria, quite strong. And Queensland's still chugging along. But when we break the data down, look at that. This is overseas migration, Graeme. So the previous slide was total migration. So this is the number of people that net gain that New South Wales had over the year to September in overseas migrants. Over 100,000 came in. And that was also during the lockdown period, mate. So you can imagine what that data is going to be when we get all the post-lockdown data. So this is why
insane.
Well, and that's why economy is strong. The housing market is strong. Rents are high. Vacancy rates are low, because of these big numbers coming in. And when we look at the interstate migration position, again, this is still reflecting that exodus out of Melbourne and Sydney during COVID lockdown. And no surprise, that's still showing up with those very strong Queensland numbers of net interstate migrants. You can see it's all coming out of New South Wales and Victoria, but it does reflect, again, Graeme, still the COVID impact of the second half of 2021 in those numbers. So only the trends are upward. It is backward looking, but we can clearly see where we're heading in terms of migration and how that's affecting the economy. So we spoke about regional markets, Graeme.
Yeah.
So let's have a look at our top regional markets here. This is New South Wales. These are the main local government areas. This is based on the number of the population, number of houses in each. So it's only the top 10 here in terms of the number of houses in each of those jurisdictions. A couple of things to point out there. These are the big performers, and what I've done is I've looked at the performances over the past 2 years. The latest data is for the quarter so far, the March quarter so far. These numbers can move around a little bit, but nonetheless, the trends are clear there. The top performer I thought was really interesting was Port Macquarie, Graeme. Of course, Port Macquarie is a couple of hours north of Sydney. It is noted for its, I guess, mid to higher price range focus. There's a lot of retirees and, business commuters that live in Port Macquarie there. It's a beautiful spot, of course. It's too far to do the real commute because we're probably talking 3 hours drive to Port Macquarie, wouldn't you say, Graeme? Out of Sydney,
a bit more. It's about 4.5. It's 5.5 from the Gold Coast to Port Macquarie, and it's about 4.5 from Sydney.
Yeah, I knew a few colleagues who used to commute, sort of virtually commute, but they'd go down to Sydney once or twice a week, and they'd spend the rest of the week at Port Macquarie. Now, obviously, with COVID and lockdown, we've seen a real surge. I think this reflects that we had a surge into Port Macquarie, particularly because of because it's perceived as being, a safe haven, a rural or regional centre, very strong regional centre, already popular with those mid to higher price buyers. And we can see there very strong growth, 40% increase in the median over the past 2 years, Graeme. So that's very, very strong. I think the other
funny story, Doc. We actually bought a house in Port Macquarie, or just south of Dunbogan, Laurelton there, North Haven. Beck did with her auntie a couple of years ago, middle of COVID. It was $565 for a block of land and to build a 4-bedroom house, and we just had it valued at $900.
Yeah.
So
there you go, 800,000. 800,000 median at the moment. You'll only see these prices here from My Housing Market, Graeme. This is exclusive, and you can see that growth. And I think that this is very much also a COVID story that Port Macquarie has had such strong growth because it's still within the I guess the bounds of the Sydney-centric type of a market. But if we look at the other end, we can see Dubbo and Wagga Wagga had very strong results also.
Yeah.
Now, they're probably a little less, well, you never know, focused on the COVID work from home environment, but I think that reflects the good value, the sort of the value proposition that Wagga and Dubbo have, being some of the more affordable regional housing markets. But they've certainly recorded quite strong growth over the past 2 years. Dubbo up 27%. And Wagga up very strong, 38% over that period. So maybe those looking for a little bit of value decided to move out of Sydney and head to those western regional areas, which Dubbo and Wagga have very strong infrastructure, and of course they have a very positive rural lifestyle. So I thought that they were interesting results. When we look at the other end, I think Wollongong was noticeable. It actually has grown by only 4.2% over the past 2 years, but it's been down over the past year. And I think that reflects the Sydney energy that we've spoken about Wollongong. The Wollongong's basically just another southern suburb of Sydney, and I think it's
only an hour down the road.
That's right. And I think that sort of precludes it from really being a regional market. But quite strong results really for most of the regional centres, but I thought the standout, and logically the standout there was, Port Macquarie, and probably no surprise there, and also some good results from the Midwest regional areas of New South Wales with that sort of value proposition kicking in. Victoria, interesting also with Victoria, Graeme, that, hang on, we'll go back, whoops. With Victoria, we can see there that which I think this is a bit of a similarity to Port Macquarie, and that's the Surf Coast. Now, the Surf Coast is south of Geelong, it's south of Melbourne. It's that beautiful area there, which has places such as Anglesea and Lorne, which are very popular areas and have been popular for some time. Let's be clear about that. And they're maybe a couple of hours drive out of Melbourne, but very strong growth in the Surf Coast there. I think that's another reflection of the, shall we call them the COVID refugees heading out of Melbourne. into that, can I use the word salubrious area of the Surf Coast, and prices growth there over 2 years of 39%, Graeme.
Wow.
Very, very strong. It's been a strong and a high price region for some time. So I guess no surprise. But so I think that's a similar scenario to Port Macquarie, Graeme, with those COVID refugees, ones with perhaps a little bit more money in their pockets, being able to afford to move down to that area to get away from the lockout energy that Melbourne unfortunately had through COVID. Shepparton, a bit like Dubbo and Wagga perhaps, that Shepparton's also recorded some strong growth. And maybe that's a reflection of the fact that it is, it does have that value aspect in terms of a lower median, and perhaps, it was a focus for those looking for some value in more of a rural location, but similar to Wagga and Dubbo. But Shepparton certainly has had strong results over the past 2 years, and Ballarat as well. Maybe no surprise there, because Ballarat's a bit of a northern suburb of Melbourne now, but a very popular area and good value, and perhaps that attracted during the lockdown period those wanting to move out of Melbourne but not to be too far away. And Ballarat was also a strong performer, has been a strong performer over the past 2 years. So I think we can, really craft a bit of a narrative around about the COVID impact on regional property values, Graeme, with that latest data. Queensland, interesting. Of course, we know Queensland generally has been a focus for interstate migration. We see that even in the latest data, even though it's a bit backward looking, that it's still very strong, the net migration into Queensland. And we know that the Gold Coast, Brisbane and the Sunshine Coast have taken advantage of those high levels of migration. But it's interesting to see we've also got some performances in other regional centres. Bundaberg, good value there, up by 43.6% over the past 2 years. Again, perhaps those looking for the rural lifestyle with some value interested in Bundaberg. And Fraser Coast, of course, which has a lot more of the resort environment on the Fraser Coast. It's also had strong growth, up by 50.3%. Again, I think that we may have seen, even those coming out of Brisbane thinking of moving somewhere which was affordable, but they could, get away from the COVID issues. And I think Fraser Coast, because that's higher, of course, than Bundaberg, is or in that same region, is has taken advantage of those of that strong migration through COVID, perhaps intrastate migration. And Noosa, although Noosa's fallen away a bit, I think Noosa's an interesting one because it does show, and these are houses, of course, we're talking about here, how strong it did grow, and it's still 31% higher over the past 2 years, despite falling 13% over the past year. So some very strong growth there. But as we know with Brisbane and the Gold Coast house prices, Graeme, that they have settled after an extraordinary period of growth. And we're not surprised there. But, given particularly the unit markets in those areas now are becoming the focus of buyers, looking for more affordable options following that remarkable boom. Toowoomba also perhaps another destination from those moving out of Brisbane to the west. It saw strong growth over the past 2 years and last year as well. Past 2 years, 32%. So, again, perhaps part of that COVID implications for people moving to areas where they perceived it was perhaps a safer environment for them, and looking perhaps for some value in some of these regions so they could move to somewhere where there was where it was more affordable. We just for a change, we'll put in Tassie in the Northern Territory here, Graeme. Doesn't get a lot of exposure. I think it was interesting that, again, it was those more outside regions that performed better over the past 2 years. Glenorchy up by 26.3%, and good old Launceston up by 23.8%. So some good growth there in those Tassie markets. And Palmerston, which is the more affordable region, or LG, in the Greater Darwin area, certainly has outperformed Darwin over the past 2 years, up by 11.7%. But the median there is still certainly low there, so good value opportunities in Palmerston compared to the Northern Territory, Graeme. So that's our regional overview.
Well,
interesting
they've
stuff.
heard it here first, Doc. It's an exclusive
Heard it here
from my
first. It's the
housing
only
market.
place you'll hear it, Graeme. Yeah, with
There's the
updated regional
report.
data. Yeah, that's right. So we finish off as usual, Graeme, with our weekend auction market wrap. Of course, we're well and truly into the year now. We've only got 2 weekends left, Graeme, but prior to the Easter break. We'll have a very big weekend, as we usually do in the weekend before Easter. We'll preview that next week. And that's the first big Super Saturday of the year. And usually the Saturday before Easter is actually the biggest auction day of the year, Graeme. We broke all sorts of records last year with auction numbers, which were a record all the way through because they were catching up from COVID. The numbers aren't as strong this year, but it'll be interesting to see how we move on. Now, of course, it was a revival weekend for auction markets last weekend, Graeme. The previous weekend, we had the Labor Day long weekend holiday in Melbourne. And quite interestingly, that Labor Day, even though the holiday is basically only in Melbourne, we also see lower numbers in the other capital city markets as well. So whether they go out in sympathy, I'm not sure. But the market certainly bounced back, and not just Melbourne. We had a surge in auction numbers last weekend. Of course, we know it's good to follow clearance rates because they tell us where prices are going. As you can see, that trend is clear in Sydney house prices versus clearance rates, and it's exactly the same Melbourne clearance rates versus house prices. So these are last weekend's results, Graeme. A big surge in auctions across the board. Melbourne, no surprise, just under 1,000 auctions following the quiet previous weekend. The Melbourne clearance rate just down a little bit. Melbourne's been a little softer over the last couple of weekends. We need to keep an eye on that one, Graeme. Just a little softer in Melbourne. It's going to have the challenges of big auction numbers over the next couple of weekends. So we'll see if, and remember, Melbourne reached 70% on consecutive weekends for the first time in a while. So it's just eased back slightly. It's still just under 70, but we'll watch out for that as the auction numbers rise, whether that can be absorbed. But Sydney up by nearly 100 auctions last weekend, but a great result for Sydney there. They're 74.5%. We shouldn't be surprised to see Sydney house prices rising again. We previewed that last week, didn't we, Graeme, when we saw that so far this month, Sydney prices are continuing to rise. But yeah, very good result there. And in fact, the Sydney clearance rate, Graeme, was higher for the first time since the same weekend last year. It's the first time we can say that in a couple of years. So a very strong result for Sydney in terms of where it's positioned now. Compare it to where it was a year ago. It's actually tracking higher. And even the Melbourne market's not that too far away from where it was a year ago as well.
There we have it, Doc. If you're timing the market, you've missed the boat. If you haven't got in, you're out.
That's right. And, it's certainly the data, not just the prices data, but the auction data is supporting that, Graeme. It's a reviving market. It's a market that's certainly improving in terms of the prospects for sellers with those clearance rates. And we have 2 weekends left until the Easter holiday break. So it will be interesting to see how this pans out. And like I said, maybe just a sign there that Melbourne had come off the boil, but still tracking remarkably about where it was a year ago. So we'll see. The next couple of weekends will tell a story in Melbourne. But Sydney bounced back hard, and that was following what was its lowest clearance rate last weekend, or the previous weekend, for the year. So it's really been a 70% plus market, the Sydney market this year. And we know history tells us those results will result in higher house prices, which they have. Brisbane, big numbers of auctions, nearly double the number of auctions in Brisbane at the weekend, Graeme. Clearance rate down a bit in Brisbane, perhaps reflecting those higher numbers coming through. Another strong result in Adelaide, again, higher auction numbers, and a big surge in auction numbers in Canberra. Again, maybe acted to push the clearance rate down a little bit. So we'll next couple of weekends, very interesting to watch, Graeme.
Watch this space
towards Easter. And if we just look at those results, the monthly results, comparing the trend, we can see that we're higher in Sydney, or around about the same level where we were a year ago in Sydney. Similarly in Melbourne, just a little bit below where they were a year ago, but certainly the best results since April last year. Brisbane just picked up recently, Graeme, despite that lower result last weekend. Adelaide's still the strongest market for clearance rates generally. And Canberra, just holding the line a little bit, but Canberra's been a bit softer this year. But the Canberra market is likely to follow the Sydney market upwards, but I think we've got local issues there in Canberra that are holding that market back just at the moment, but we'll see if it responds to what's been a revival in the Sydney market. So if you want those clearance rates, you can get onto my LinkedIn site every Saturday night. You'll get the snapshot of the capital city results hot off the press at around 6:30. And Sunday mornings, you get the full national auction market report, which will give you the regional breakdowns for Sydney and Melbourne, and also give you the top sales in Sydney, Melbourne, Adelaide, Brisbane, and Canberra. So look out for that one. And that's us for this week, Graeme.
There we go. You heard it here first, exclusive. You won't get anywhere else, anyone. The regional housing market update from My Housing Market from Dr. Andrew Wilson. And stay tuned next week for some very strong, interesting data coming out. And tonight around the interest rates internationally. And Doc, we'll see you on the weekend at the masterclass.
Yeah, looking forward to that, Graeme. We've certainly got lots to discuss, haven't we? And I'm looking forward to all those questions that we get, which are certainly
challenging. That's the best part. All the questions from all the attendees.
Yeah, we love that. So good stuff, Graeme. And, another big week, US. What are the US going to do with interest rates? How are retail sales going to land? Will they follow strong results from the employment market? And we'll also maybe have the latest results for March, full results for the March quarter housing market in terms of prices.
There we go. Looking forward to it. Thanks as always, Doc.
Thank you, Graeme.